Hello everyone, so today I'll be talking about index funds or exchange traded funds, otherwise known as ETFs. What are index funds or ETFs? Why do people invest in them? And how do you pick one and invest in them? So first, let's start off by comparing the two investment strategies, active investing versus passive investing. Active investing involves the active selection of individual investments that are believed to be able to outperform the market. So active investors think that it is possible to beat the market by buying and selling assets at the right time. So this will require them monitoring daily news, corporate announcements, reading up on shareholder letters, investor presentations, quarterly earnings results, and annual reports, etc. in order to make an informed decision of whether to buy or sell an asset at a particular time. So this requires significant investment in terms of time and effort. So if an investor wants to have a shot at beating the market but do not want to spend so much time researching on a stock, then he or she can invest in a mutual fund that is actively managed, or invest in a hedge fund whereby there will be a fund manager that will invest your money on your behalf in assets that meet his or her selection criteria. And it is with the hopes that he or she will be able to beat the market on your behalf. But of course, for someone to do all this heavy lifting for you, you will have to pay them fees. So hedge funds typically have a 2+20 fee structure whereby they will charge you a 2% annual management fee in terms of the assets under management, and also a 20% performance fee that is applied on the profits that they generate for you. While for mutual funds in Malaysia, typically there will be an upfront sales charge which can range up to as high as 5.5%, and there will also be an annual management fee of between 1% to 2%, and also an annual trustee fee of between 0.05% to 0.08%. So with all these fees involved, the fund manager will not only have to outperform the market, he or she will have to outperform the market by more than the fees that they charge you in order to still create value for you. Now, passive investing. Passive investors do not believe that it is possible to beat the market consistently, so they take a backseat approach and just invest in the market. To start off, there are different types of markets. We have the stock market, fixed income market, forex market, commodities market, cryptocurrency market, etc. And within the equities category alone, there are many different sub-markets. You have markets that cater to different geographic regions like US, Europe, Asia. Then you have markets that cater to different sectors, technology, utilities, banking, etc. And then you have those that cater to different investment styles like growth versus value investing. So you can invest in a particular market just by investing in an index fund. Now, what is an index fund? First, let us look at indices. There are thousands of indices globally, each of them consisting of many assets, and these indices track the performance of their underlying assets on a daily basis. For the purpose of my video, I will focus on stock market indices. So let me give you some examples of popular indices. The S&P 500 index, which consists of 500 large company stocks in the US. These companies have demonstrated 4 consecutive quarters of profitability and are large enough, so they are included in the index. Then you have the Dow Jones Industrial Average Index, which consists of 30 blue chip stocks listed in the US. Then you have the Nasdaq Composite Index, which consists of stocks listed on the Nasdaq Stock Exchange, and mostly they are technology stocks. So these 3 stock market indices are the most widely followed indices by global market participants. Now, an index fund is just a fund that invests in the assets that make up a particular index, while an exchange traded fund, an ETF, is just an index fund that is traded on a stock exchange, meaning that you can buy and sell the ETF freely on the exchange as long as you hold a brokerage account with the exchange. So an example of an ETF would be the Vanguard S&P 500 ETF, which invests in the stocks that make up the S&P 500 index. Now, what are the benefits of investing in index funds or ETFs? First, compared to the active investing strategy, it allows you to save a lot of time and effort, as it is not necessary for you to monitor the actions of all the companies that you invest in, given that you are already diversifying your exposure across a variety of stocks. Second, investing in index funds or ETFs makes for a good long-term investment strategy. Market timing does not make much of a difference to investors who are consistently investing in the market over long periods of time. Now, the returns that you get from investing in an index fund will mirror the returns of the underlying assets that make up the index that your index fund is tracking. So there can be years when the market is booming and your fund is performing well, or there can be years when the market is sluggish and your investment performance is bad. But if you commit to investing a certain amount of funds in the index fund, no matter the state of the economy, you just put in money at preset intervals, then across time, the losses that you make during the bearish years will be balanced out by the gains that you make during the bullish years. So overall, over a long term, the investment performance of your index fund will be an average of the results of many years of your investment. So the fluctuation will not be too extreme when it comes to returns. In fact, the returns are pretty good considering that you don't need to spend much effort for this strategy. Take, for example, the S&P 500 index. According to historical records, the S&P 500 index managed to record an average annual rate of return of approximately 10% to 11% for every year since its inception during 1926. So that is pretty good. And if you look at the most recent year, 2020, the index managed to record a gain of 16.26%, which is remarkable given that there was a market crash during March 2020 due to the global COVID-19 outbreak. Now, since ETFs have been performing quite well in recent years, actively managed funds have been having a challenge trying to beat the market. So there has been a rise in popularity in ETFs in the US and Europe, whereby investors are increasingly trying to allocate their funds to ETFs because ETFs come at a lower cost, which can help to maximize returns. So the third benefit will be lower costs. Because ETFs are passively managed, their fees are low compared to mutual funds or hedge funds. Take, for example, the Vanguard S&P 500 ETF, which invests in stocks included in the S&P 500 index. It has an expense ratio of only 0.03%. So this means that if you invest $10,000 in that index fund, it will only cost you $3 in fees annually. Compare that to the 2% annual management fee charged by a hedge fund or a mutual fund. A $10,000 investment will have cost you $200. So that's a difference of $197 annually. So it may not seem like a significant difference right now for 1 year, but if you take that $197 and you invest it and say you can get an annual rate of return of 10% for the next 10 years, then by the end of 10 years, that amount would have grown to $511 because of the compounding effect. So actually, fees can matter a lot when it comes to your ultimate return on investment. Now, the fourth benefit, last but not least, would be diversification. When you invest in an index fund, you're spreading your money across a wide variety of assets with different characteristics. So this helps you to reduce your portfolio risk. Diversification occurs when you invest in assets that have low correlation with each other. Low correlation means that the performance of one asset does not have close linkages to the performance of another asset. So for example, compare technology stocks to utility stocks. During booming years, technology stocks will rise significantly in value. But for utility stocks, well, their value will remain almost the same no matter the state of the economy, because whether the market is booming or in a recession, people still have to pay their utility bills and the amount wouldn't change significantly over the years. So these two stocks, they have low correlation with each other. And since index funds pool your money across different types of assets, you would be able to reduce the risk of your portfolio just by investing in an index fund. So how do you select index funds or ETFs that you want to invest in? There are a variety of ETFs tracking different asset classes, and within equity index funds, there are index funds that track different geographies, different sectors, and different investment styles. So say you want to gain exposure to the US stock market, then you can consider the Vanguard S&P 500 ETF, which includes 500 large companies in the US that have demonstrated profitability. Or if you want to gain exposure to the whole US stock market, then you can consider investing in the Vanguard Total Stock Market ETF, which gives you exposure to close to 4,000 listed companies in the US. Or if you want to gain exposure to emerging markets, then you can consider the Vanguard FTSE Emerging Markets ETF, which gives you exposure to emerging markets such as China, Brazil, and South Africa. This can give you high returns, but also they come at higher risk. And say if you want to gain exposure to dividend stocks, you can consider the ProShares S&P 500 Dividend Aristocrats ETF, which invests in stocks in the US that have demonstrated a growth in dividends annually consecutively for the past 25 years. Or if you prefer growth stocks, then you can also invest in the Vanguard Russell 1000 Growth ETF, which invests in growth stocks in the US. So which one do you pick? It would have to align with your investment goals, your investment time frame, as well as your level of risk tolerance. Next, you would also want to compare the fees of the different ETFs that are tracking the same index. So take, for example, we have two index funds tracking the same S&P 500 index. The SPDR S&P 500 ETF has an expense ratio of 0.09% versus the Vanguard S&P 500 ETF, which has an expense ratio of 0.03%, which is lower, although they both track the same index. So usually investors would prefer the one with the lower expense ratio. Third, we have to look at the tracking error of the index funds. So tracking error is defined as the difference between an index fund's returns and the performance of the parent index that the index fund is tracking. So we want to choose an index fund that has the smallest tracking error. Now, fourth, liquidity. So liquidity, it means that when you buy an asset and one day you want to sell it off, there is sufficient liquidity, sufficient trading interest in the asset such that when you want to sell it off, there will be a willing buyer such that your sale will not impact the price of the asset significantly. You can start investing in ETFs by opening a brokerage account with an international brokerage platform like Interactive Brokers, which is based in the US. This brokerage gives you access to a wide variety of ETFs globally. However, they do charge quite high inactivity fees, which can range up to $20 per month, as investors generally invest in ETFs for the longer term and do not trade those ETFs every month. So typically these inactivity fees will be incurred for the ETFs. So it would not be attractive if you are a long-term investor. Now, alternatively, you can also invest in ETFs through Bursa Malaysia. ETFs have been around in Bursa Malaysia since 2005. However, the local ETF market is still relatively small. There are only 19 ETFs currently available, but they do give you exposure to global and local equities, Sharia-compliant equity, fixed income, and also commodities like gold. You can start investing in ETFs through Bursa Malaysia by opening a brokerage account with a local stock brokerage. So personally, I'm using Rakuten as they have one of the lowest transaction fees in the Malaysian market. If you would like to explore trading or investing through Rakuten, then you can check out the link in my description section below to the Rakuten website. And if you use my referral code when you sign up, we will both get rewarded. Do note that the ETF market in Malaysia is not that liquid, so this is a thing to consider. However, because most people are investing in ETFs for the longer term, it is expected that over the longer term, interest in the ETFs will rise. So this can help to improve the liquidity of ETFs, so it shouldn't be too much of a concern for now. Alternatively, if you do not want to select which ETFs to invest in by yourself, you can opt to use a robo-advisor. Now, robo-advisors are digital platforms that are driven by artificial intelligence. They use algorithms to help allocate your funds across various ETFs globally, depending on the information that you provide to them, such as your salary, your financial situation, financial goals, and level of risk tolerance. So in my next video, I'll be comparing a few robo-advisors that are available in Malaysia, which I will link to the video once it is completed, so you can check out the description section and I will link it when it's done. So that's it for today. I hope that you have learned something new and that maybe you can start to invest in ETFs by yourself. So please don't forget to click on the like button if you have enjoyed this video or learned something new, and also click on the subscribe button to subscribe to my YouTube channel, and also turn on the notification bell so that you will get updates when my next video is out. Alright, so thank you for watching, take care and stay safe, and I will see you in my next video.